Money market and capital market in India. Part 4. E. Discount and Finance House of India. The Discount and Finance House of India was set up in 1988 as a money market institution based on the recommendations of the Waghul Committee. It is jointly owned by the RBI, public sector banks, and financial institutions to impart liquidity to the money market instruments. Second, unorganized sector. The unorganized money market in India comprises of indigenous bankers, money lenders, and unregulated non-bank financial intermediaries. The activities of the unorganized money market are largely confined to the rural areas. First, indigenous bankers. They are financial intermediaries that function similar to banks. They mostly deal in indigenous short-term credit instruments such as hundi. The rate of interest differs from one market to another. Indigenous bankers are mostly confined to certain social strata. They are an important source of funds in unbanked areas and provide loans directly to agriculture, trade, and industry. Second, money lenders. They mostly operate in the villages. Money lenders usually charge a high rate of interest. The loans provided by money lenders are for both productive and unproductive purpose. Agricultural laborers, small and marginal farmers, artisans, small traders, etc. usually borrow money from the money lenders. At present, the activities of the money lenders have been restricted by RBI due to their exploitative tendencies. Third, unregulated non-bank financial intermediaries. They include chit funds, nidhi, loan companies, etc. Under chit funds, members make regular contribution to the fund. Bids or draws are made on the basis of a criteria mutually agreed upon by the members. Accordingly, the collected fund is given to the chosen member. Chit funds mostly operate in Kerala and Tamil Nadu. Nidhi is also a type of mutual benefit fund, thriving on the contribution of its members. Loans are provided to members at reasonable rates of interest. Loan companies are finance companies. They provide loans to traders, small-scale industries, and self-employed persons. Being unregulated, they charge a high rate of interest on loans. Unregulated non-bank financial intermediaries are nidhi, chit fund, and loan companies. Do you know money market instruments? The following instruments are traded in the money market. Call/notice money market. When money is borrowed or lent for a day, it is known as call. Overnight money. When money is borrowed or lent for more than a day up to 14 days, it is known as notice money. Treasury bills, TBs. They are short-term instrument issued by the RBI on behalf of the government to meet temporary liquidity shortfall. Commercial papers, CPs. It is an unsecured promissory note, negotiable and transferable by endorsement and delivery with a fixed maturity period. Certificate of deposits. They are unsecured, negotiable instruments in bearer form issued by commercial banks and development finance institutions. Commercial bills, CBs. They are short-term, negotiable and self-liquidating instrument with low risk. Role of money market in India. The following points outline the role of money market in India. First, short-term requirement of borrowers. Money market provides reasonable access for meeting the short-term financial needs of the borrowers at realistic prices. Second, liquidity management. Money market is a dynamic market. It facilitates better management of liquidity and money in economy by the monetary authorities. This in turn leads to economic stability and development of the country. Third, portfolio management. Money market deals with different types of financial instruments that are designed to suit the risk and return preferences of the investors. This enables the investors to hold a portfolio of different financial assets, which in turn helps in minimizing risk and maximizing returns. Fourth, equilibrating mechanism. Through, through rational allocation of resources and mobilization of saving into investment channels, money market helps to establish equilibrium between the demand for and supply of short-term funds. Fifth, financial requirements of the government. Money market helps the government to fulfill its short-term financial requirements on the basis of treasury bills. Sixth, implementation of monetary policy. Monetary policy is implemented by the central bank. It aims at managing the quantity of money in order to meet the requirement of different sectors of the economy and to increase the pace of economic growth. A well-developed money market ensures successful implementation of the monetary policy. It guides the central bank in developing an appropriate interest policy. Seventh, economizes the use of cash. Money market deals with various financial instruments that are close substitutes of money and not actual money. Thus, it economizes the use of cash. 8. Growth of commerce, industry and trade. Money market facilitates discounting bills of exchange to local and international traders who are in urgent need of short-term funds. It also provides working capital for agriculture and small-scale industries. Problems of the Indian money market. Compared to advanced countries, the Indian money market is less developed in terms of volume and liquidity. Following points explain the problem of the Indian money market. First, dual structure of the money market. Presence of both the organized and unorganized sector in the money market leads to disintegration, lack of transparency, and increased volatility. The unorganized market lack coordination and do not come under the direct control and supervision of the RBI.